Hey everybody. So the title of this video is Reverse Mortgage, Why Everyone Over the Age of 62 with at least 50% equity should have one. Now I know that that's a bold statement. I know that some of you are sitting here watching this video with a sincere desire to learn more about the reverse mortgage. But I also know there's some of you that are watching this video with a degree of skepticism. If you trace the origins of that skepticism back, it probably started from before the mortgage collapse. You have to remember back then, there were, and I use the term loosely, loan officers who were flipping burgers at McDonald's one day, and then they were loan officers the next. And as a result, because of no experience, no real oversight and licensing, there was a lot of bad actors. And as a result, there were loan officers that were putting seniors into this loan, which is really a great loan. It's an FHA insured loan. It's insured by the federal government. And they weren't informing the seniors and educating them about everything that they needed to know about the loan. Namely, that even though you don't have a principal and interest payment anymore, you do still have to pay your property taxes and your insurance. And if you have HOA, you still have to pay your HOA. So what I'm going to do is before I move forward, I'm going to ask you, if you have not subscribed to our page here or to our channel, please subscribe and hit that like button. We really appreciate it. It helps with the algorithms, okay? So without further ado, let's move into the presentation. All right, so the first thing I want to do is I'm going to tell you guys what to expect during this presentation. So the first thing that we're going to be going over is how to access equity, because in retirement, cash is king, right? You can have, a home that's worth $800,000 and have $600,000 worth of equity, and it does you zero good unless you have the ability to be able to access it. Then we're going to talk about qualifying for a loan in retirement, because it doesn't matter. I mean, I hear this all the time from people. I've got $900,000 worth of equity, and yeah, I only have a couple $1,000s a month coming in from Social Security and from a pension, but I need to be able to access that money. But you have to be able to qualify for it, even in retirement. Doesn't matter how much equity you have. And then we're going to go over demystifying the reverse mortgage. There's a lot of bad information out there. So I'm going to try and give you some good information in this video. The reverse mortgage is also called a HECM, which stands for Home Equity Conversion Mortgage. So we're going to go over those facts. Before we move any farther, I'm going to start out with a quote. And believe it or not, this is from Frank Zappa. He says, "A mind is like a parachute. It doesn't work if it isn't open." So folks, I realize there's some skepticism, but for the purpose of these, the next 10 or 15 minutes during this video, please try to empty your mind of skepticism and watch this with a sincere desire to learn, okay? So what we're going to talk about first is equity versus cash. So the $100 bill that you see up on top there, that represents equity, and that is a rubber $100 bill. No matter how much you try, you cannot spend a $100 rubber bill, right? Nobody wants it. And nobody cares whether or not you have equity. If you cannot access that equity, it does you zero good. So the goal is to turn that equity into cash, something that you can go to the store with and buy groceries, or, go on a trip, or, help your grandkids out, whatever that might be. So what we're going to talk about first is what we call the three buckets, the sacred cow of home equity. So the first bucket over on your left over there, that represents your wages, right? Throughout your life, you get paid. Every week, every month, every year, you bring in money. And with that money, you take the majority of it goes into pre-retirement income that you pay your bills with, you pay your car payment, maybe student loans, maybe you're buying, property, maybe more than one property. And then a portion of those wages goes into post-retirement income via pensions and Social Security. But so let's take a look let's move up to the pre-retirement income up here, and let's talk about what happens on a monthly and an annual basis, right? All of that money that comes in, we're constantly spending it. We're taking a portion of that and we're putting it into 401k, stocks, and bonds. And why are we doing that? Because eventually when we retire, we need money, right? And then the other part of that pre-retirement income towards your nest egg will also go into your home. It goes into, when you make your monthly payment, not only are you paying down your mortgage, but you're also paying interest on that mortgage, right? Here's the thing, guys. In retirement, the majority of us, what we do, and this is because this is what we were taught in the past, is we take annuities, we take distributions from 401ks, from stocks, we might cash out in bonds, and we strive to add to our Social Security, right? So we have our monthly income. Unfortunately, what happens is that most Americans do not touch their home equity, and it just sits there. Now, you might say to yourself, well, Barry, it doesn't just sit there. It goes up in value, and eventually I have something maybe that I can leave my heirs. Folks, there are other ways to leave money for your heirs. Yes, that your home goes up in value, but it continues to go up in value the same way it would if you didn't have a reverse mortgage, if you have a reverse mortgage. As the value goes up in your home, that equity that you're accruing does not belong to the lender, no more than it does in a conventional mortgage, right? If your house is worth, $600,000 today, and then 3 years from now it's worth $700,000, who gets to keep that extra $100,000? You do, right? You just have to make sure that you pay the lender whatever's owed to that lender. Well, it's no different with a reverse mortgage. With a reverse mortgage, what you're doing is you're taking the interest from the mortgage or from the loan that you have, and you're adding it onto your mortgage. So let's say that you start out with a loan amount, let's say of $300,000. Well, the FHA figures and the Mortgage Bankers Association figures, especially here in California, that homes are appreciating of a clip of around 4% annually. Now, interest rates on a reverse mortgage right now, because interest rates are so low, interest rates are below 4%. They're down into the low threes. So now on a $300,000 loan, if you add on 3% interest onto that $300,000, that's $9,000, right? But let's say that your home, the value of your home was $600,000, and that went up 4% over the course of the year. Well, that's $24,000 that your home has appreciated, as opposed to the $12,000 that got tagged onto the loan. So you can see the home is rising and that money still belongs to you. So the question is, why do we not touch that equity? If it's because you want to leave your kids something, go get a whole life policy. Go, imagine leaving them $2 million in the stock market or in a 401k. Imagine actually giving them cash. When you give them a home, they have to still go out there and sell it. They still have to pay commissions to the real estate agent to be able to sell it. It makes more sense, folks, to tap into the equity and take less money out of the market, especially when we see these wild swings in the market like we have over the last 3 or 4 months. The most of the financial planners out there that are watching this, and the ones that maybe you have a financial planner, they tell you there's a 4% rule. And that 4% rule means that if you want to keep all of your investments available to you, you need to take no more than 4% out of the market. So if you have $1 million in the market, the most you want to take in order to preserve that $1 million is $40,000, 4%, right? Now, since the virus hit, we know that some financial planners have actually lowered that to below 3% because of the wild swings. But the last thing you want to do when the market is swinging like that is cash out of stuff at a loss. You wouldn't be doing that if you had less money that you had to cash out because you have no mortgage payment, because you don't have a principal and interest payment. So I'm going to use this example that I prepared for a client to give you guys an idea of how this works. So in this example, this client has a loan of approximately $274,000 after the first year being in a reverse mortgage. Now, the property value at that time is worth about $650,000. You'll notice in equity that the difference between that 274 and the 650, that belongs to the client, that $375,000, right? Now, let's jump ahead 20 years from now. The home is appreciating in value. The loan is also going up because you're taking the interest that you normally wouldn't pay, and it's getting tagged onto the loan. And after 20 years, it is roughly $640,000, a little more than $640,000. Now look at this. After 20 years, according to FHA and the Mortgage Bankers Association of America, that home would be worth approximately $1,369,000. So yes, the loan amount went up, but so did the value of the property. And take a look all the way over to the right. The amount of equity has also gone up significantly. In fact, it's just about doubled from when you originally bought the house. So the myth that money belongs to the lender is just not true. Yes, the value of the house goes up, that belongs to you. Yes, your loan amount goes up. It's just the way that the reverse mortgage works, but here's the rub. You don't have to let it go up. If you decide that you want to pay your interest on that loan each month, you can do that. And when you do that, that money that you paid immediately becomes a line of credit for you. So, I mean, guys, it's just an incredible loan. We go throughout our whole life, spending just a ton of our income on our mortgage. And then when we retire, we have to figure out, how do we squeeze the money out of this? Well, you might think about a cash out, right? If you've got a loan for, $300,000 and your house is worth $800,000, maybe you can take a loan out and increase the amount of mortgage that you have and pull out an extra $150,000. Or hey, maybe you can go down to the local bank and you can get a home equity line of credit. Well, guess what? When all this was happening with the lockdown, all of a sudden banks were starting to panic a little bit. Rules started changing. Here's an article from Bank of America where they're reassessing the ability to be able to give out home equity lines of credit, and also lowering the amount of credit that might be available to you in your current home equity line of credit. Now, we know this happened back during the collapse, right? The values of the homes were dropping and banks were yanking that line of credit away from borrowers. So just because you have a home equity line of credit for $150,000 doesn't guarantee you that if something were to happen, that $150,000 couldn't get taken away from you. This is directly from AARP. They say that between 65 and 69, the mean income, which is the household income, is about $79,000. For the purpose of this presentation, we're going to say $80,000 just to kind of round it off. And then 70 to 74, $68,000. Once again, for the purpose of this presentation, we'll say $70,000. And we'll take the difference between those two, which is $75,000. This is what the average senior should have or could have in retirement, right? So we're going to look at now what the debt to income ratio requirements are to be able to get a conventional loan or to get a jumbo loan. Actually, let's use a conventional loan, and I'll just briefly tell you what the guidelines are for jumbo for right now. But we're going to talk about debt to income ratio. How much money do you need to make in order to qualify for a loan? We're going to take in to get all of your debt obligations to figure this out, including the new loan that you're trying to get. And then we divide that by your monthly gross income. So we're going to use that $75,000 a year. We're going to divide that by 12 months in the year. And that equals $6,250 of your net income, right? Or your gross income, sorry. And then we're going to divide that by 50 because remember I said for a conventional loan, you have to be below 50% debt to income ratio, which gives you about $3,125 of usable income. Now let's imagine that you had a $400 car payment and then you had a $200 revolving credit card debt monthly payment, right? This would give you the ability to take on a new loan of about $2,525, which would leave you with about $3,125 to be able to use for food and electricity and trips and helping your kids or whatever. So my question to you is, why would you want to do that? If you don't have to make a mortgage payment, why wouldn't you take that $2,525 and add it with the $3,125 so you have a better quality of life? Or hey, maybe you might want to take some of that and get a whole life policy to leave to your family. Or maybe you might want to help one of your kids buy a house or your grandkids. Why would you want to set up a monthly mortgage payment for you? We know that since the everything's gone down with this pandemic, that the government has come in and you guys have probably heard this term of forbearance. Basically, they came in and they said, hey, all of you guys that are in trouble right now, in fact, everybody, if you can't make your mortgage payment, just call your lender. And part of the CARE Act is they will put you into forbearance where you don't have to make a payment for at least 3 months. And then you can extend it to 6 months and then maybe even to a year. Now, how would it feel if you were if you had that same ability to never make a mortgage payment forever? Wouldn't that be incredible? You know how many Americans would jump all over that today? But for some reason, we have it in our heads that that is a bad thing for seniors. Now, here's the rub. You guys can also use a reverse mortgage to buy a new home. Let's just say that you lived in, Murrieta, and you had a little place in Murrieta, and you paid it off. All of your kids lived in, Costa Mesa or Stanton or wherever it is, and you're just too far away from your kids and your grandkids. You could sell that house and take that $300,000 and put $300,000 down on a new home. Let's say you were 62 years old, which is approximately, you need about 50% to put down. And you could buy a $600,000 house, probably in a better area, closer to your kids. And you would be accomplishing the same thing that you had in Murrieta, which was when you had your house, you wanted to pay it off so you had no mortgage payment, right? Well, going and using that $300,000 to buy a $600,000 house with no mortgage payment is essentially the same thing, right? Here's an example of, buying a home today, around $500,000, putting 20% down. I'm using the figure, you can't see it there because it's blocked by my head, of 3.25%, not because I'm promoting an interest rate, it's because that's about what rates are right now. If you've got great credit and at least 20% down and low debt to income ratio. But essentially, you're taking on new debt of $2,500 a month. Now, this includes, your property taxes and your insurance. But in a reverse mortgage, if you put down $250,000 on that $500,000 house, you would eliminate that $1,900 a month principal and interest payment, and you'd only be responsible for the property tax and the insurance. I'm using another figure here of $700,000. Once again, let's just say that you had $350,000. Maybe part of it was in a home that you sold, and maybe some of it was in the stock market. I've got a client right now that is considering doing a reverse mortgage, and they're talking about taking out $150,000 out of the market because to them, that represents about $1,000 a month of income in retirement. Doesn't it make more sense to eliminate $2,400 a month in a mortgage payment as opposed to, getting rid of $1,000 of potential income? I'll spend $1,000 to save $2,400 all day long, right? So let's just say, here's your other option. You might want to just go, okay, well, I have a house worth $600,000 and I owe $200,000. I'm going to sell it And I'm going to take that $400,000 and I'm going to put it in something and hopefully be able to live off of that. Well, where do you go from there? If you sell your house, you're going to have to go rent somewhere, right? The median rent over the United States just since 2012 has gone up from $1,300 a month to almost $1,600 a month, just since 2012. And we don't see that stopping anywhere else. So the smartest thing to do when you're a senior is to, make sure that you have your fixed income, that you have expenditures that are not going to change on you. And the best way to do that is obviously owning a home, right? How about eliminating that mortgage payment on top of that? It just makes sense, right? So I'm going to end the video now by dispelling some of the myths about the reverse mortgage. First of all, you have to be 62 years or older. Now, in 2015, they changed the law where, let's say that you're 62, but you have a wife that's 55. You can still qualify for that reverse mortgage, and she would go on title, and if God forbid anything happened to you, your spouse would be able to take still live in the home, and they would never have that principal and interest payment. However, we're going to go by the spouse's age, the younger person, but you would still be able to qualify if you're at least one of the spouses is 62 years or older. It has to be an FHA qualified home. So, if you're in a townhome or a condo somewhere that's not FHA approved, it wouldn't work. You just have to live in the home for at least 6 months and 1 day out of the year, because it needs to be considered your primary residence. I'm doing a reverse mortgage right now from a client that they have two homes. They have one in Illinois and one out here in Cyprus. And, they're going to do the reverse mortgage on the one in Cyprus. So you can own more than one property, but the property that you are going to be doing the reverse mortgage on, you need to live there at least 6 months and 1 day out of the year. It has to be known as your primary residence. Okay. The myth out there is that if something ever happens to you, the bank gets to keep your home. Folks, that's just not the case. It's no more the case than if something were to happen to me today, and my home, my wife, went through probate and finally got the rights to the house. It doesn't mean the bank gets to take it. It just means that if she doesn't want that mortgage, she's going to need to sell the house, pay the loan off, and then she keeps the difference. Your heirs have up to a year to be able to either sell the house or refinance it. And if you pass away and your spouse still lives there, they get to stay in the house until they leave this earth. Now, the homeowner owns the property with the lender. We just said that. Depending on the age would depend on how much equity you need. I just said to you that if your spouse is much younger than you, you might need more equity, right? It's easier to qualify. It used to be prior to the collapse, you didn't need to qualify at all. But now, since the collapse, you need to be able to prove that you have enough money coming in monthly to be able to at least pay for the property taxes and the insurance. And if you have HOA, that as well. And as I mentioned, the heirs have 1 year to sell the property. So folks, I'm going to end it with this. Everybody's situation's a little different. What I would encourage you to do is to reach out to us. Let's just talk about your individual situation. If you're watching this and you're thinking about this for your mom or dad or your grandparents, you're not going to get any kind of a strong arm approach for us. We're there to we're a full service lender. We do, reverse mortgages and we do forward mortgages. Our goal is to make sure that whatever loan you get, it's the best loan for you. Okay, so I know this has gone on quite a long time, but I hope that you guys learned something from it. I hope everybody's safe. I hope everybody's healthy, and hopefully we'll talk to you soon. Take care.